Right now, as we speak, Radiopharm Theranostics ADR, trading under the ticker RADX on the Nasdaq, is quoted live at $11.96 per share, ripping upward with a staggering intraday gain of 156.68%, effectively more than doubling in value in a single morning session. If you are watching the tape, you are seeing a vertical green line that defies the gravitational pull of the broader market, a move so violent and so specific that it demands your immediate, undivided attention. This is not a drill, and it is certainly not a glitch in your Interactive Brokers trading platform. This is a repricing event based on hard, clinical data that has just hit the wires. The volume is pouring in at a rate that is currently eclipsing the stock's historical average by over 50 times, creating a liquidity vortex that is sucking in day traders, algo bots, and institutional eyes all at once. When a stock moves 150% in a few hours, the natural expectation, the knee-jerk reaction that most seasoned traders have, is to assume this is a pump, a fleeting momentum spike driven by hype or a misunderstood press release that will inevitably fade by the closing bell. You expect this to be a trap, the kind of volatility that burns retail investors who chase the green candle too late. You look at this and think, this cannot hold. But here is the reality that contradicts that expectation. This move is anchored in a 92% clinical success rate for a Phase 2b trial in one of the most notoriously difficult indications in oncology, brain metastases. This isn't a vague partnership announcement or a plan-to-plan update. This is interim data showing that their imaging agent, RAD101, successfully identified tumors in 11 out of 12 patients, matching the gold standard of MRI, but potentially offering the biological specificity that MRI lacks. The market is not just speculating today, it is mathematically recalculating the probability of success for a company that was, until this morning, largely flying under the radar of the Main Street investing sites and major indices. While the vast majority of the market is fixated on the usual suspects, watching the tick-by-tick movements of Nvidia stock or wondering if Apple stock can break new highs, Radiopharm Theranostics has delivered a data set that fundamentally alters its valuation thesis. The gap between what the market thought RADX was worth yesterday, essentially a speculative microcap shell, and what it is trading at right now represents the realization that their platform actually works in humans. This is the tension between a skeptical market and undeniable data, and right now the data is winning. To understand why this move is sustainable and not just a pop and drop, we have to look closely at the trading mechanics unfolding on your screen. If you pull up the chart on your Fidelity mobile app or your thinkorswim terminal, you will see that the buying pressure is not just aggressive, it is relentless. The stock opened significantly higher, but instead of fading, it is flagged and consolidated at these elevated levels, which is a hallmark of institutional accumulation rather than just retail frenzy. In the world of self-investing, distinguishing between a retail swarm and institutional buying is critical. Retail traders, often using the Robinhood app or similar platforms, tend to exhaust their buying power quickly, leading to sharp spikes followed by immediate pullbacks. What we are seeing with RADX today implies that larger entities are stepping in to defend these higher prices. They are digesting the news that RAD101 has achieved its primary endpoint in 92% of the subjects. This specific endpoint, concordance with MRI, is critical because brain metastases are often treated with stereotactic radiosurgery, where precision is everything. If a surgeon or oncologist misses a lesion, the patient relapses. If they treat healthy tissue, the patient suffers neurological deficits. RAD101 uses a specialized molecule that hunts down the tumor cells and lights them up on a PET scan, potentially finding disease that other scans miss or confirming disease with higher biological certainty. The market's reaction today is a direct response to the de-risking of this asset. In biotech investing, risk is binary. You either have a drug that binds to its target or you don't. Yesterday, investors didn't know if RAD101 would work. Today, they know it works in 92% of the interim cohort. That effectively removes a massive layer of uncertainty, which is why the price spike is so violent. It is not expensive at $11.96 relative to the potential of a successful oncology diagnostic. Rather, it was mispriced at $4 because the market was pricing in failure. This brings up an interesting point about how we construct our portfolios. Many of you might rely on Schwab Intelligent Portfolios or other automated tools to manage your wealth. Those systems are designed for slow, steady compounding, often shielding you from volatility. But they also shield you from these idiosyncratic black swan-like upside events. A robo-advisor like the SoFi Robo-Advisor or the automated tier of Fidelity Wealth Management is not going to catch a 156% move in an Australian-domiciled Nasdaq-listed radiopharmaceutical. This is the domain of active, informed speculation, the kind that requires you to step outside the safety of index funds and understand the science behind the ticker. Let's talk about that science, because it is the engine driving this train. Radiopharm Theranostics operates in a sector called theranostics, which is a portmanteau of therapy and diagnostics. The concept is elegant. You use the same molecule to find the cancer, diagnostic, and then, by swapping the isotope, you use it to kill the cancer, therapy. It's a see-it, treat-it approach. RAD101, the drug causing today's explosion, is the diagnostic arm. It targets a specific transporter on the surface of cancer cells. The fact that it showed high uptake in brain metastases is incredibly bullish, not just for the diagnostic potential, but for the therapeutic implications down the road. If you can see the tumor clearly with the diagnostic version, you have a much higher confidence that the therapeutic version will be able to deliver a radioactive payload to those same cells. This is why the stock isn't just up 20% or 30%. The market is extrapolating the success of the diagnostic to the potential success of a future therapy, which is where the real blockbuster revenue lies. It is crucial to contextualize this move within the broader market. If you were trading Tesla stock today, you might be looking at macro factors, interest rates, or EV demand. If you were looking at Fidelity investments in broad market ETFs, you'd be watching the Federal Reserve. But for RADX, none of that matters. This stock is trading purely on idiosyncratic clinical risk. It is decoupled from the S&P 500. This is why having a portion of your portfolio in individual brokerage accounts where you can execute on these opportunities is valuable. You cannot capture this alpha through a passive vehicle. However, the risks are as high as the rewards. We must be realistic. This is an interim analysis of 12 patients. In the grand scheme of oncology trials, 12 patients is a tiny sample size. The statistical power is strong enough to trigger this rally, but it is not a guarantee of Phase 3 success or FDA approval. The expectation now shifts from will it work to will it work in a larger population. This creates a new wall of worry that the stock will have to climb in the coming months. Let's look at the company behind the ticker. Radiopharm Theranostics is not a novice operation. It is led by Ricardo Canary, a CEO with deep experience in the radiopharma space, specifically from his time at Novartis, which is the global leader in this field. Management pedigree matters immensely in biotech because the science is only half the battle. The other half is navigating the regulatory labyrinth of the FDA. The fact that they have already secured FDA Fast Track designation for RAD101 is another bullish signal that was likely overlooked by the market until today's data validated the approach. Fast Track status means more frequent meetings with the FDA and a rolling review process, which can shave months off the approval timeline. For a company burning cash, as all clinical stage biotechs are, time is literally money. Speaking of cash, this price spike changes their capital market strategy. Typically, when a small biotech stock triples or quadruples, management will look to raise capital. They have a currency now, their stock, that is much more valuable than it was yesterday. Investors should be aware that a secondary offering could be on the horizon to fund the pivotal trials scheduled for late 2026. This is standard operating procedure, or what you might call the reality checking the expectation of infinite gains. If you use Interactive Brokers Trading or a similar professional suite, you can actually track the bid-ask spread widening during these halts and resumptions. This indicates that market makers are struggling to price the incoming flow. The liquidity is there, but the volatility is making execution difficult. This is a stark contrast to the smooth, deep liquidity you experience when trading huge caps like Nvidia stock. In the microcap biotech world, execution is an art form. You have to be careful with market orders. If you just hit buy on your Robinhood crypto